Welcome to Talk Tickers. We know you're busy, but you need to get a handle on what's moving the markets.
And that's what we do here. We cut through the jargon.
Exactly. Today, we're tackling the latest Infosys earnings call. That's INFY. Our job, to pull out the essential info you need fast.
No need to wade through the whole transcript. We've got you covered.
Okay, let's kick off with the results snapshot. What did FY25 look like overall?
Okay, so fiscal year 25, they saw revenue growth of 4.2% in constant currency. Pretty decent.
And margin?
Operating margin landed at 21.1%. They also generated a really strong $4.1 billion in free cash flow.
Wow. And deal wins. That's always key.
Huge deal wins. $11.6 billion in large deals for the year.
Okay. And drilling down into the last quarter, Q4?
Q4 specifically, year-on-year revenue was up 4.8%, and they kept that operating margin right around 21%.
But the outlook for next year, FY26, sounds a bit more cautious.
It does. The guidance is for revenue growth between 0% and 3% in constant currency, so a wider range.
0 to 3%. Okay.
And the operating margin target is 20% to 22%. And importantly, this guidance doesn't factor in a recent acquisition they made.
Got it. Okay, let's dive deeper then. FY25 results, that 4.2% growth. You said it was maybe better than initially expected. What fueled that?
Yeah, it seems things weren't quite as uncertain as feared. They mentioned easing worries around, interest rates, maybe elections, geopolitics, that sort of thing helped.
Less turbulence.
Right. Plus, their own market position is strong. They pointed to those big deal wins we mentioned. Mm-hmm. And also, importantly, a bit of an improvement in discretionary spending, particularly in financial services. That kicked in.
And were there specific areas that really outperformed?
Definitely. Financial services was one. Europe was another big one. And manufacturing all grew faster than the company average for the full year.
Europe stood out, you said.
Especially in Q4. They clocked 15% growth in constant currency in Europe just in the fourth quarter. It's a really strong momentum there.
Okay, let's talk profit. That 21.1% operating margin for the year, up 50 basis points. How'd they manage that with, headwinds like pay rises and deal costs?
That's a really good question. They absolutely faced those pressures, compensation bumps, costs for ramping up those large deals, acquisition amortization.
Standard stuff, but still a drag.
Exactly. But they counteracted it, largely through something they call Project Maximus.
Project Maximus? What does that involve?
It sounds like a mix of things, focusing on value-based selling, making operations leaner, and really pushing automation and efficiency gains.
So not just cutting, but optimizing.
That seems to be the idea. And it clearly paid off in terms of supporting those margins.
And the cash flow was another bright spot you mentioned.
Absolutely. $4.1 billion in free cash flow. That's 129% of their net profit. Really healthy signal.
Shows strong financial discipline.
For sure. And on the deals front, 96 large deals closed in FY25. That $11.6 billion total value, over half of it, 56%, was net new business.
Net new. So winning new logos, expanding footprint. Good signs. Headcount.
Headcount was actually up year on year by about 6,000 people. And attrition seems contained around 14.1%.
Okay. And dividends for shareholders.
Yep. The board proposed a final dividend of 22 rupees. That brings the total for FY25 to 43 rupees. That's up 13.2% from the previous year.
Okay, so FY25 looks solid in the rear view. But Q4 itself, you mentioned revenue dipped sequentially. Why was that?
Right. Sequentially, Q4 revenue was down 3.5% in constant currency. They broke it down roughly.
How so?
About 2/3 of that dip was due to a reduction in third-party costs passing through. That can fluctuate.
Okay, the pass-through element.
Yeah. The other third was, a mix, some volume decline and just fewer working days in the quarter.
Simple calendar effect sometimes.
Exactly. And they also mentioned a few deals they expected to close. Well, they slipped a bit, pushing out of Q4.
Timing issues. Happens. Okay, that covers the past. Let's look forward again. That FY26 guidance, 0% to 3% growth. Why such a wide range?
Yeah.
Seems quite uncertain.
It really does signal heightened uncertainty. They're looking at the whole macro picture, potential tariffs, economic slowdowns, how that might hit client spending.
So the low end assumes things get worse.
Pretty much. Lower end implies further deterioration. The higher end, 3%, assumes things kind of stabilize or maybe improve slightly.
And that's before adding in the impact of the new acquisition.
Correct. That's not baked into this 0-3% range yet. So another variable to watch.
They also mentioned something about third-party costs for FY26.
Yeah, based on what they see in the pipeline now, they expect both the costs and the related revenue from third parties to be lower in FY26 compared to FY25.
Interesting. So that could dampen the top line a bit, but maybe help margins.
Potentially, yes. That's one way to look at it.
And on margins, the guidance is 20% to 22% for FY26. What's the thinking there?
They're basically banking on Project Maximus continuing to deliver those efficiency gains.
To offset ongoing pressures.
Right. Things like wage hikes, integration costs for acquisitions.
Yeah.
They expect Maxis to keep providing a buffer.
Makes sense. Any other guidance points? Tax rate. Cash flow.
Yes. Effective tax rate expected around 29-30% for FY26. And they still anticipate free cash flow to be strong, above 100% of net profit again.
Okay, consistent on cash flow. Let's get into the weeds a bit, sector by sector. Financial services, how's that looking?
Financial services seems relatively stable. Budgets are seen as flat to maybe slightly higher.
Where's the spending focused?
Key areas seem to be AI adoption, regulatory compliance work, always a factor there, and of course, cost management projects.
Steady areas, any specific subsectors?
They expect steady growth in capital markets and also cards and payments. And they noted the mortgage sector could see an uptick, but that depends on interest rates coming down.
Right, rate dependent there. Okay, manufacturing, what's the picture?
Manufacturing is a bit more mixed. For calendar 25 budgets, they're seeing lower expectations in auto and industrial manufacturing. Others seem flat.
What's driving the caution?
Tariffs, trade barriers, those are casting a shadow, likely dampening spending. They specifically called out continued weakness in auto, especially in Europe.
So what are manufacturing clients focused on doing?
A lot of focus on cost takeouts, transforming infrastructure, and ERP modernization projects. Core stuff.
Makes sense in a tougher environment. What about retail? Always sensitive to the economy.
Yeah, retail is definitely feeling that economic uncertainty, lower consumer spending.
So budgets are tightening.
Expected to tighten further is the message. The focus there is shifting more towards AI for efficiency, cloud modernization, obviously cost out initiatives, and core tech upgrades.
And decision making.
They noted that decision cycles for discretionary projects in retail are getting longer, more cautious.
Okay. How about energy, utilities, resources, and services? Sounds like a brighter spot.
It does seem more resilient. They reported continued growth and a strong pipeline there.
Any specific drivers?
Seeing new opportunities in mid and downstream energy in the U.S. Also, more M&A activity and tax-related work bubbling up among their services clients.
And the focus areas for IT spend.
Things like AI-driven transformation, software services using Infosys' own IP-based solutions, cloud migration, and vendor consolidation are big themes too.
And they made an acquisition here recently, right?
Yes, that should strengthen their hand in energy trading and risk management specifically.
Okay, last couple. Communication and high tech, how are they faring?
Communication sector is still pretty soft. Discretionary spend is under pressure there. Clients are focused on cost-cutting, restructuring.
Where's the growth coming from then?
Mostly from deals they've already won and opportunities around cost reduction, AI, database work, cybersecurity.
Right.
They also floated the idea that lower interest rates could help the telco equipment guys, which might eventually flow through.
Okay, a bit of a wait and see. And high tech.
High-tech clients are mostly cautious. Macro headwinds, tariffs again. Discretionary spend is still squeezed.
Any other pressures?
Yeah, they mentioned margin pressure on the clients themselves, partly due to big commitments they've made on data center spending.
Interesting dynamic. Okay, AI came up a lot. How deeply is it embedded now? Is it just talk or is it in the deals?
It sounds like it's really becoming central. They say AI is part of basically all new deal discussions now.
Moving beyond just pilots.
Yeah, they talked about an AI-first transformation approach using AI agents, intelligent automation. It's becoming core to the solution design.
And in existing projects.
They're using it there too for process improvement, engineering, customer service enhancements, cybersecurity, even employee productivity boosters.
Any examples they shared?
Yeah, they mentioned helping a U.S. financial services firm with conversational AI. And a European company where they're automating, I think, 70% of processes through an AI-first approach.
That's significant automation. Does that mean less revenue for Infosys eventually if clients get too productive?
It's a fair question. They acknowledged AI drives productivity, which could impact volume. But their view is that overall, AI engagements will still drive revenue growth. The nature of the work changes.
And pricing for this AI stuff, is that settled?
Sounds like it's still evolving. The focus is on the efficiency gains for the client. How that value gets shared, whether through pricing or tied into broader transformation deals, seems flexible.
Right, often part of a bigger package.
Huh.
Okay, we talked about third-party costs impacting Q4 revenue. Can you just recap the outlook there?
Sure. The Q4 sequential dip was partly because those third-party costs and the revenue tied to them came in lower than expected. Some related deals also slipped.
And for FY26?
The expectation is that level of third-party cost and associated revenue will be lower in FY26 than it was in FY25, based on current deals and pipeline.
Okay. And just to circle back one last time on margins, the Q4 sequential movement.
Right. The dip in Q4 margin was mostly driven by those compensation costs kicking in, plus some impact from acquisitions.
But there were offsets.
Yes. Partially offset by lower costs and things like postage, customer support, plus the ongoing benefits from Project Maximus, and some favorable currency movements helped too.
And despite those headwinds throughout FY25, the full-year margin actually improved because of Maximus.
Exactly. And they expect that project to keep delivering into FY26, hence the projection for further potential margin improvement within that 20-22% range.
And those recent acquisitions fit into this strategy?
Seems so. Energy consulting, cybersecurity, plus a new partner in their Japan JV, all aligned with strategic areas. Though, again, the latest acquisition's impact isn't in the main FY26 guidance yet.
Okay, thanks. Stepping back now, thinking like an investor listening to this, what are the main takeaways? What should people be watching?
Well, first, that cautious FY26 revenue guidance is the big signal. It screams macroeconomic uncertainty, especially around tariffs and potential knock-on effects on client spending.
So monitor the macro environment closely.
Absolutely. Second, the clear client focus on cost optimization. It's an opportunity for Infosys, sure, but also shows where client priorities are shifting.
Plays to their strengths, but also indicates pressure.
Right. Third, the strength in Europe and the continued success in winning large deals are definitely positives to track. See if that momentum continues.
Anything else to watch?
Yeah, definitely keep an eye on how quickly they can ramp up those big deals they've won. That's crucial for hitting growth targets. And watch for tangible results from the AI initiatives. Are they translating into real revenue and efficiency?
What about those third-party costs?
The expected decline there, it could dampen reported revenue growth, but as we said, might actually help margins. So need to watch both lines.
And pricing. Stable for now,
but potentially vulnerable if the macro environment really deteriorates. That's always a risk in this industry.
Okay, that's a great summary of the investor context. Now for our favorite segment. This is not financial advice. Time for an outrageous but plausible trade idea based on this call. What have you got?
Okay, let's get speculative. Thinking about that client focus on cost takeout and efficiency, and that strategic energy consulting acquisition. Here's a paired trade idea.
All right, let's hear it.
Go long, Infosys. The bet is they capture more demand for their cost optimization services, plus they get synergy benefits from that energy acquisition as that whole sector restructures, moves to cloud, sees M&A.
Okay, long INFY. And the other side of the pair?
Short. Maybe a large European industrial company. One that's potentially stuck with older IT systems, heavily exposed to that struggling auto sector they mentioned, and facing those broader European headwinds.
So betting on the shift away from legacy IT in challenge sectors towards efficiency players like Infosys, especially with their energy kicker.
Exactly. It's playing that divergence, capitalizing on the IT spending shift towards efficiency, and targeting a specific area of weakness highlighted in the call. Outrageous, maybe, but plausible given the commentary.
Love it. A classic pair trade idea rooted in the call's details. Okay, that wraps up our deep dive into the Infosys earnings call.
We've hit the key results, the drivers, the outlook, the sector trends, AI, margins.
And even a speculative trade. What stood out most to you listening in? Any questions about their AI push or how they'll navigate this uncertain year?
Let us know your thoughts. But remember, this is purely informational.
Definitely not financial advice. Please do your own research. Join us next time on Talk Tickers for another earnings call breakdown. Until then, stay informed.